What I really look at when evaluating a deal are rates as well as demand. Today, I'm just going to have a conversation with Chase, who does all of our modeling, sharing exactly what we're looking at and how we're changing how we look at deals to get to a hell yes quicker, metrics that will allow investors to get behind it and really understand the deal. What a couple of those numbers are and how we protect those numbers and how we've been modeling.
There are 4 key KPIs that really make or break a deal. Primary one that you've probably heard of is IRR, internal rate of return. It's susceptible to changes in cap rates, changes in time. There's a lot of variables that go into it. The other 3 are equity multiple, cash on cash, and then yield on cost. And once you understand the formulas behind what really make up those metrics, you can really start to have a better understanding of whether or not a deal is going to be successful. And just to go into a little more detail on what IRR is, it's essentially your cash flows over a period of time, including the sale, cash flow from sales. So kind of levers that you can pull on with that are time, for one. The shorter you hold it, the higher the IRR is going to be. Your annual cash flows, the higher they are, the higher your IRR is going to be. And then your sale price at the end is a huge factor that plays into whether or not the IRR is going to be high. I'll go ahead and go in here and change a couple metrics so you can see how it changes. So leverage is another big one. So here we have it leveraged 65%. You can see we changed that to 50. The IRR drops 3%. Now I'll go back to 65. If we have a 7.25% interest rate, we change that to 9%. The IRR changes. We change that to 5%. The IRR goes up significantly. So these are all things when you're evaluating a deal. A big way that you can get kind of lost in the sauce of IRR is over promising cash flows because it plays such a large part. We lean very heavily on the conservative end of our expenses and our revenue. Revenue is really dictated by the rate that we get per square foot. So we're always, 10 to 20% below what we think we're actually going to get. And then if it's, what market is, it's overperforming and it's a positive. So we ensure that deals work at both lower rents and higher expenses to just kind of vet the deal and make sure that it actually works.
What I really look at when evaluating a deal are rates as well as demand.
I'll kind of go into another metric that we look at, which is cash on cash. The formula for cash on cash is pre-tax cash flow divided by total equity invested, not including principal payments on a loan. So that's the equity you're bringing up front. And I'll just kind of change some stuff in here so you can see that right now, our stabilized cash on cash is 15.8%. So you can see that cash on cash differs a little bit from IRR. It's not taking into account the sale. It's just doing annual cash flows. So time does not affect cash on cash, but how much you lever will. So I'll go ahead again and change a couple numbers. And you can kind of see this is the loan amount that we're doing. So if I change that to 80, you can see that our cash on cash goes up. If I change our rate, our cash on cash differs drastically. So a higher rate, lower cash on cash. If I drop the rate down to 5%, it goes up significantly. So again, these levers can be pulled and it can drastically change the returns projected. Same with rate. So I go in here and change this $1.30 to $1.50, drastically changes cash on cash. So it's our responsibility to make really good assumptions and do our significant amount of due diligence to make sure that these levers are as conservative and accurate as possible.
If you are looking to invest in a deal, make sure that those 3 T's are checked. What's your track record? Do you trust them? Have they done other deals? And are they being transparent? Like, are they willing to really show you the model and back up the assumptions with real data? Like, what is the market really? Is it 10 by 10, $120, or is it 99?
We look at each metric and have it play a little bit of an influence on, our ultimate decision to move forward. If the IRR is really high and the cash on cash is really low, it means that we're over assuming what our exit value is going to be, and the cash flows, the annual cash flows aren't really there. It's a lot of implied value at the end when we're selling it, which is based on a cap rate, which is an assumption, and you can make good assumptions around that. These are all things that can, really inflate or deflate a deal.
And once you say it's kind of a delicate dance between IRR, cash flow, all of these different metrics that we come in, they all get factored in and rolled up. And I feel like that's the mistake that we made. We focused on IRR so heavily, but there's so many other metrics.
When we were looking at IRR, which has changed now, we were levering deals heavily with using SBA loans. And then we were assuming a 6% cap rate, which is industry standard. In a lot of markets, you're going to get a 6% cap rate. But to get even more accurate, you have to kind of do your digging and understand maybe it's not going to trade at a 6 cap. It may trade at a 5 cap. It may trade at a 7 cap. And I can kind of show you what the cap rate, how changing the cap rate will change the value of a deal. So this one, for example, we have a 6 cap. We felt like this market, based on, comparable sales, that a 6 cap would be justified here. So our exit value is 17.9 here. And you can see this is the IRR. This is the cash on cash. If we change that to a 7%, which is a drastic change, but it's possible, you can see that our IRR drops drastically. Our cash on cash stays relatively the same, does stay the same because it's not taking into account sale price. The cash flows don't change. But you can see our exit value drops over $2 million. So these are, obviously very important. If it gets, lower to a 5 cap, our IRR goes up, cash on cash stays the same, and our exit value is $2 million on the other end. One number can change whether or not a deal moves forward drastically, and it's our job to validate those numbers.
Through, our track record doing $90 million in deals and, having a really good group of advisors and subcontractors that we work with helps us flush that out, not only from the broker level, but from the boots on the ground to knowing the markets that we're in, a spreadsheet. It's so many other things involved in that.
Talking about subcontractors, CapEx, which is essentially how much it's going to cost, is a huge factor for another metric that we look at, which is yield on cost. Yield on cost kind of allows you to look at a deal, not thinking about cap rates, not thinking about exit value, but really looking at the intrinsic value, the cash flow of a project. Yield on cost formula is stabilized NOI divided by total project costs. And that's why it's so important to get really, really good estimates from our subcontractors and contractors, that they know what steel prices are, they know what labor is going to cost. They'll give us a number and we'll still be conservative on that.
One of the differentiators for Storeit is we're very intentional with on time and on budget and modeling it out correctly. If it takes an extra 6 months to do, that affects your IRR.
This is our base level model. We use this model because it's easy for us to do kind of plug numbers in quickly and vet a deal initially. And then we have another separate model that goes way more in depth, gives us yield on cost, gives us equity multiple, and really vets and stress tests the cap rate, stress tests the rates, and really gets granular on whether or not a deal is going to work. We're able to compare the two models together and see this model's off a little bit. Why is that? Time may be different.
In this model, we use a blended rate for all of the units. So we have some RVs, some carports, some small units, big units. It's a blended rate. But in the other model, we put each unit in there.
Breaks down on an annual basis. So assuming we started 2025, the other model we use breaks down on a monthly basis. It's giving you that much more information, which banks love to see and we love to see. You get more detail looking at it on a monthly basis. The other model more so just uncovers some potential shortfalls of this model. If I look at this model and our IRR is great and our cash on cash is pretty good, I'll look over at that and see if the yield on cost and equity multiple align with that, and just to double check and make sure that everything's clicking.
And what would you recommend for someone new to the self-storage space that wants to do development? They don't have this model, they don't have the other model, figure out if it's a hell yes or a hell no.
Well, one, I would maybe not start with development. Maybe
that would be my recommendation too.
Maybe start with an acquisition. The brokers do a good job of, if it is an acquisition in an existing facility, the brokers usually do a good job of piling together, they'll have these metrics for you. We don't always, we take that information, but take it with a grain of salt and run it through our program, obviously. Once you know what to look for, you can start to see what may be a little bit off. If you are going to go into development, overestimate, be conservative on your estimates on cost and rent. Just because one facility their rent is super high does not mean that your facility is going to be the same. You got to look at product type, what they're offering versus what you're offering. Look at rate trends. People typically underestimate their front end CapEx, so their capital expenditures in the beginning, how much construction is going to cost. And for a development deal, oftentimes you can underestimate what your expenses are going to be on an annual basis. It's a little easier with it's way easier with an acquisition because you already have expenses in place and you already have rents in place and you kind of know what you're getting into. But development takes a little more experience.